Welcome to the Choose FI Radio Podcast, Episode 3. It's time to talk about the fees.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
So today we're in the studio and we are going to be specifically talking about a topic that is very important to most of the financial independent retire early community, and that is the importance of avoiding excessive fees.
It is such a fundamental topic, and we wanted to make one of our very first podcasts about this.
So we're going to do one of the things that you're supposed to avoid at all costs on a podcast, and that is talk about numbers. And on this particular show, we're going to violate that rule a lot.
Hopefully this works out. We'll see.
I think it'll work out really well. We're going to cross some bridges here. Brad, you just want to kick this thing off and let us know epiphany.
Yeah, for sure. So pretty much like everybody else, I'm an investing moron. I had no idea what I was doing for years and years and years. You sign up for your 401k, you get this list of 20 or 30 mutual funds, and you have no idea what you're looking at, right? What do you do when you look at it, John?
You know, it really is difficult to dig down in there and figure out exactly what you're looking at, and even to know how you're supposed to look at it. So I think a lot of us just kind of ask our peers, or maybe we do a Google about the top 5 funds, something like that.
Yeah, that's the two things I think most people do are ask the guy in the cubicle next to them, and look at the Morningstar ratings. And how many stars did Morningstar give it for its performance over the last year?
Oh, so that's not what you do.
Right? Well, thankfully, I've kind of come to a conclusion here. And on the backs of many, many brilliant people, this is nothing that I did on my own. But once I've kind of realized this, that fees are the most important thing, and that index funds and low-cost ETFs are the way to go. It's almost like you want to stand up on the top of a mountain and scream it to everyone, like, do not invest in high-cost mutual funds. Do not invest in actively managed funds, or God forbid, like a hedge fund or something where they're giving away 2% and 20% of the profits. I mean, these will destroy your long-term wealth, absolutely destroy it. My realization here came about after reading a couple of different items. And the first was Jim Collins. He writes over at jlcollinsnh.com. He has a brilliant series called the Stock Series. I'm not sure, at last count, he's probably up to about 30 different blog posts in that particular series. And he's actually turned it into a published book called The Simple Path to Wealth.
And rightly so. That is a phenomenal series.
Oh, it's brilliant. And Jim has become a good friend of mine over the last couple of years. And I consider him a friend and a mentor. And I tell him every time, literally reading those articles changed my entire life. It changed the entire course of my investing life. You don't get that every day. What have you read on the internet lately that has changed your life? It's pretty rare. And so then I moved on to a book called The Little Book of Common Sense Investing by John Bogle, the founder of Vanguard, right? It's brilliant. And when you put together these different sources of information, you realize it's like an aha moment that there is no way that my feeble little brain that's full of emotion and fear is ever going to outperform the market. It's simply not. You hear that, I'm not sure if this is a true thing or not, but I heard 6 months ago that Fidelity put together a study of which of their investors have performed the best over the last X number of years. And it was the joke or the realistic answer, but the joke is the people who were dead, right? It's the people who didn't trade, didn't try to outsmart anything, didn't get fearful when everyone was selling or get exuberant when everyone's buying and the stock market's going up. It's the people that just kept the course. And, in this case, because they were dead, right? But keeping the course, not letting your emotions get into it. So, that is essential in and of itself. You are not going to find some brilliant financial advisor that your brother-in-law uses, or the guy at the Edward Jones office right down the block from you.
And how many times do you hear that? I have a guy.
Right. I have a guy. Like, he's some brilliant person. The likelihood of you finding that brilliant financial advisor is as close to zero as possible. And just looking at the performance of actively managed mutual funds. So let's, kind of pivot a little
All right,
bit.
so we're focusing in on one. Absolutely.
So actively managed mutual funds. I mean, there is really no correlation in the results of these things. There are very few that outperform over years and decades, right? I mean, do you know of any, Jonathan, that, I mean, maybe the Fidelity Contra Fund, I think for a while outperformed, but they all eventually revert to the mean. And that's if you're lucky. If you're very lucky, the actively managed mutual fund that you're going to select is going to perform as well as the market. Because again, you're getting all these fees just built into it, trading fees, taxes, all this stuff just further cuts down on your return and the return of that mutual fund. And
so what are we talking about? Are we talking about it's costing you, $20, $50? Can we attach some numbers to what these fees are actually going to be costing us?
No, that's a great segue. Before we went live here, I wound up pulling up the investment calculator, which Jonathan just turned me on to. We'll have a link to this in the show notes. Just kind of for shits and giggles, I threw in some numbers here just to kind of prove the point. So basically what we did was we initially threw in that we were starting with $100,000. Okay. That's a lot of money for many people, but just bear with us here. We figured over a long term, over a 40-year period, the stock market is going to return, let's say 8%. It might be plus or minus, but that's at least reasonable based on history. In this hypothetical, we're not putting any additional money into it. It's just that 100K on day zero, and we're going to let it ride for 40 years. Okay.
Let it ride, brother.
Yeah. So in this scenario, we said we didn't hire a financial advisor and we didn't get sucked into an actively managed mutual fund. We just invested all 100,000 in the VTSAX, which is Vanguard's total stock market index fund. That has an expense ratio of 0.05%.
Now, just for our audience, that's a good expense ratio?
That is a absolutely fantastic, minuscule. I mean, many actively managed funds, I mean, maybe in this day and age, it's hard to find ones over 1%, but you can certainly for many, many years, they've been 1%. Even on international funds, you'll see 1.3 and upwards of that. Many of them will have 0.6, 0.7. And that doesn't sound like a lot of money, right, Jonathan?
Well, no, it doesn't. I mean, it's better than the interest rate my bank is giving me right now, but yeah, it doesn't sound like a lot.
Right. So it sounds minuscule. So many people intuitively think, how can 0.6% and 0.05 like you're getting in VTSAX or 1% and 0.05, how could that really make a difference for me long term? It's just such a tiny amount. It's less than 1% of my assets, right? And what we're going to try to show here is what a difference it makes. So the first scenario we ran, like I said, is just putting in VTSAX. So it reduces our return from 8% to 7.95. Okay.
All right. So $100,000 after you pay your expense fees, you're making an annual rate return of 7.95%, and we're letting it ride for 40 years.
So it compounds for 40 years.
All right, what do we got?
It's $2.13 million.
Wow.
Yeah. So $2,132,000.
So basically right now you're saying $100,000 guarantees you're a millionaire.
Yes.
Multi-millionaire.
Multi-millionaire just for putting it away, doing nothing with it, waking up in 40 years, looking at your statement and needing a cardiologist, essentially.
Okay.
As John Bogle would say, that's one of my favorite quotes of his. So what we did was scenario 2 is we invested the same $100,000 in VTSAX, and for whatever reason, we decided to hire an investment advisor. Okay, they usually charge 1% of assets under management, so that further reduces your fee by your return by 1%. So in this scenario, we had the 8% gross return. We reduced it by the 0.05 from the mutual fund and 1% in the investment advisor.
So it sounds like now basically you have $100,000, and now your annual rate of return after you pay your fees is 6.95%.
Yep, correct. So we hit calculate, and it comes out to $1.4 million. $1,469,000.
Holy crap. Do you realize the implications of that? That one change, I just did the math on my calculator. You just lost $630,000.
Yeah. Is that amazing or what? Just by having that financial advisor who honestly is probably just a salesman. I mean, the likelihood of your investment advisor being Warren Buffett is zero.
So if you had $100,000 and you were about to invest it for 40 years and you just heard this and changed your mind on how you do it, feel free to send me a thank you card with a $10 gift card in it to Panera Bread, because that just saved you $630,000.
Yeah, just from that one change. All right. Your investment advisor, he might be a nice guy. He might be able to help you.
Is he worth $630,000?
Not a chance.
No way.
Not a chance in hell. The third scenario was doing everything wrong. Okay. We started with that 100 grand and we had the 1% investment advisor and we had a 1% actively managed fund. Because in all likelihood, if you're going to some brilliant investment advisor, he's not going to put you in VTSAX because he can't justify his fee then.
Yeah.
So he has to justify his brilliance by putting you in some fantastic mutual fund that he found. And those mutual funds have a significant expense ratio. So just for this back of the envelope thing, we're assuming a 1% expense ratio in that mutual fund. So that reduces our annual rate of return from 8% down to 6%.
All right. So now in this third scenario, this really, really bad scenario, you got 100 grand. And now because of all the fees that you're paying out to the various parties, you're only making a 6% rate of return and you're still letting it ride for 40 years.
Yep. So we hit calculate and the total worth after 40 years is $1,028,000.
Oh, wow. That just cost you over $1 million.
Yep.
That one choice led you to your advisor. The other choice led you to VTSAX. The difference between those two, that seemingly innocuous choice, was $1.1 million.
Yep. Or more than 50% of your potential return if you just put it in VTSAX.
That is crazy.
Yeah.
That's crazy.
It's just because that little innocuous, it's just 1% of my assets. It's nothing. It's something.
Do you think that would be something that somebody should tell you before you get off into the world and you're just making your own choices? That seems like that would be a useful piece of information to know.
Yeah, without a doubt. And honestly, also a big thing in this is psychological. And I know I can speak from experience. When I had no idea what I was doing, I was constantly thinking about, am I in the right mutual fund? Am I doing this right? Should I rebalance between my international and my Fidelity Contra fund and some other mid-cap fund and all this other nonsense? I had no idea what I was doing, but that was just what everybody was saying. So it sounded logical. Now I put every single dollar into VTSAX. And now people of good faith, people of intelligence, certainly in the Bogleheads community and such, people will argue of, should I put some in bonds? Should I put some in international? And that's fine. Again, people of good faith can have that argument. And I'm not saying my way is right.
Well, and I think you can take this and you can, there's some actionable tips that you can come out of it. And we're not necessarily telling you that you have to do VTSAX, although we love that fund. What we're saying is that fees matter. And if you didn't understand why they matter going into this podcast, they matter because it's the difference of millions of dollars. And whose pocket do you want that $1 million to be in? Because it could have been in yours. Just think about it for a second.
Yeah. That's a brilliant point. And so that's the ancillary benefit, again, is the psychological aspect of this, that I sleep well at night. I don't think about this. To paraphrase that quote from Bogle, it's if you put in regular investments and don't try to time the market, don't try to be brilliant, just buy a little piece of every publicly traded United States company. That's what the total stock market index fund is. It's you own a tiny little piece of every publicly traded company in America, 3,200 or thereabouts companies. And you're betting on America. Like Warren Buffett always says, he is bullish on America. And 40 years from now, you're going to wake up and you are going to have more money than you could possibly imagine. And you never had to time it. You never had to think about it. And like we talked about these fees, the likelihood of success. This is one of those odd things in life where normally having knowledge and having information puts you ahead of the game. Here, with investing, it almost hinders you in most cases.
As long as the one piece of information is the tiny little bit that we're giving you, then yeah, absolutely.
True. No, absolutely. But right, these superbly sophisticated hedge fund guys or whatever, like most of them don't really know their ass from their elbows, frankly. And over the long run, I am confident in the United States stock market and I'm confident in the fees. Fees matter.
And also, you say the United States stock market, but a lot of those companies that you're investing in are in fact global powers. So if you invest in every major company inside the United States, you are by definition also investing in global companies all across the world.
Yeah, without a doubt. And just to kind of further this point here is looking at Warren Buffett's annual shareholder letter to Berkshire Hathaway. One of the most interesting quotes that I've ever heard that kind of helped corroborate this. If Warren Buffett agrees with this, then he's the most brilliant investor of all time, essentially. He laid out a retirement plan that he's leaving behind for the trust for his wife. And quote, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's." That's Warren Buffett saying what he's going to do with the billions of dollars that he's leaving. He's going to put it 90% of it in a low-cost Vanguard index fund. Now, he chooses the S&P 500. I personally choose the total stock market index fund. At the end of the day, because it's cap-weighted, they mirror each other almost identically. But in this case, you're getting an additional 2,700 companies that you're getting a tiny, tiny little piece of. But at the end of the day, the advice is the same. Go with the market and go with low fees.
Here's your takeaway. Here's your big assignment. Do you know what your expense ratios are in the funds that you're invested in, whether that be your 401k with your employer, your 403b, whether it's in your taxable accounts? Do you understand the expense ratios for both the funds that you're in, actively managed funds versus index funds, and how your advisor, your financial advisor, is paid? Is it fee for service where you pay them a flat rate? Do they charge an assets under management fee? That's your assignment for this week. Go lock that information down. And over the coming weeks, we're really going to continue to highlight this idea and help you figure out what a better way would actually look like, one that keeps more of your money in your pocket. If you heard this and you're like, wow, that is something I wish I had found out about sooner. And what are the other things that I don't know? Keep listening. Lots of great information coming your way. Also wanted to let you know that in October of 2019, we released our book, Choosify, Your Blueprint to Financial Independence. It takes the big ideas, the big concepts from the first 2 years worth of episodes and turns that into a linear story. It's fun. It's engaging. It's easy to understand, to read. It's a perfect handbook to have as you're starting to think about which one of these ideas you're going to take action on and incorporate. You can find it anywhere books are sold: Amazon, Barnes & Noble, your independent bookstore, your library. And if you want to purchase a copy, you can also just go to choosify.com/book. I think it's a fantastic book that you're going to want to dog ear and reference and highlight and tear up as you start digging through different concepts. I also think it's a fantastic gift for a friend or family member that you're trying to introduce to this concept to get them on board. This is one of those things that you're like, wow, this information is amazing. Why didn't I learn about this 10 years ago, 20 years ago? Well, you're learning about it now, and you can help the next generation find it sooner by sharing this information with friends, family, and coworkers. So again, just go to choosify.com/book, and we will see you in the next episode where I share my story of how I went $168,000 in student loan debt for a degree and how I dug my way out. We'll see you next time.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.